of the other things we observe relating to that, Dan, is when we look at the lag between concern and fear and how does that have people operate and how does that impact the economy, what we have observed pretty broadly is people slowing down hiring, so doing interviews and so forth, but not yet actually actively hiring people in many cases, slowing down on some R&D type of investment and development because of uncertainty. And one of the things that we are assuming will have at least some impact is that reduction in less consumer income, less corporate spending a quarter out from now, that's when we see that. So there's a lag in seeing that show up in earnings and so forth. But as we likely get Q2 earning information, our assumption is there will be some impact from the uncertainty that has already unfolded. Hard to know how much, but that's certainly something that we keep an active eye on.
Oh, absolutely. I think for now we see most of the decline in sentiment indicators, but the harder indicators, I think, if they're probably going to come next. Now, as I said, Trump has at some point to pivot to the part of his agenda that businesses and voters want, which is grow the economy, drop inflation. So again, the Scott Bessent 3-3-3 plan, 3% growth, 3% deficit, and 3 million barrels of oil, so cheap energy. Now, energy prices are dropping, of course, but
that does have a direct impact, as we know, on the consumer, right?
Yeah.
As far as just more money to spend has a very high correlation. So that is a positive wind from a consumer perspective, which, of course, the U.S.-based economy is highly consumer driven.
Right. And the other thing is, I mean, for businesses, especially small businesses, deregulation will be critical. It just takes a long time because, again, to go through the deregulation process, it takes, 3 to 6 months. It can get gummed up in court. So as we know, that takes a bit longer. And then, of course, the other thing is the tax cuts and where they fall. I think I have the chart on the right. I think you get unpaid for spending somewhere around $3 trillion between the House and the Senate proposal, but I don't think it hits until after mid-year, probably August. The debt ceiling may have to be separated to it. It's a complicated bill. I mean, it's possible that they punt or they extend the 2017 tax cuts, which wouldn't add. But again, markets are counting on this, and the propensity of Congress to spend more as tariffs do damage will actually increase. So we could end up with a closer to the Senate Republican proposal, which would be $6 billion more or less, 5.8 over 10 years in unpaid for spending. Now, that's not great for the deficit. I mean, they're gonna game and the scoring of it and the dynamic scoring in Congress. But I think that my initial view is that the number is going to be smaller because of spending cuts. But again, if you have pain from tariffs, you have to increase sort of the fiscal stimulus, so to speak, to keep the economy going. So I think this number should come in. I think it's closer to August, but we'll see. It's something obviously to watch very closely. The devil will be in the details. And fiscal legislation is always very difficult to move. Now, shall we turn to inflation and rates? Great. So just a few things. Tariffs are sky high, chart on the left. I mean, if tariffs as they're implemented, we're back to 19th century level. They're above the Smoot-Hawley of 1930s. Now, the thing is, tariffs are actually not inflationary. They're actually usually deflationary, or very often, not always. And the 1920s, 30s example chart in the middle shows this tariffs were increased, the CPI dropped. And why? Because tariffs are fundamentally a consumption tax with a domestic producer rebate. But what they do is they reduce consumption, they reduce the GDP, and of course that is deflationary. I leave aside the monetary policy of the 20s and 30s, which is of course deflationary as well. But fundamentally, tariffs are not necessarily inflationary. Of course, they can be. If you increase prices and prices are passed to consumers and businesses, that can lead to inflation. Jay Powell yesterday came out and said as much, that he's afraid basically of stagflation. He's afraid of high unemployment and higher inflation. But they're usually one-off step. They don't, unless you have a continuous trade war, usually you get a one-time bump in inflation. It could be stagflationary for a while, and then it goes away. I think the biggest thing here in terms of tariffs being inflationary that's not talked about is that, as you said, the supply chains are being disrupted. Well, disrupting supply chains is inflationary, at least in the beginning. We saw that with COVID, was clearly chart on the right. And if you look at other events, the first China trade war, COVID, Russia, the Japanese earthquake, Every time there is a major impact and you have again a sort of a supply chain shock, that actually correlates pretty well with bumps in inflation. So that's again something to watch. So again, we're not out of the woods. Of course, the Fed is worried about this. I mean, they're going to stay higher for longer probably to see how inflation plays out.
A
Over
really interesting one because that's going to have a really big impact. There's a lot of debate going on in the market right now around how much will the Fed cut rates, how quickly, but there's real inflationary pressure, as you pointed out, Dan. It might be more short-term oriented, but
Mhm.
it's there. And I think also your point of the devil's in the detail, there'll be some areas that are going to be hit with inflationary impacts, some aren't. It'll depend a lot on what the product is, what the service is, and where is it coming in from. And so that's a good thing for people to be aware of. But in general, the way that we've been thinking through it is there's for sure fear and concern, and that definitely has both consumers and corporations slow down spending, and therefore, how does that not end up moderating, some of that inflationary impact? And when you reference COVID, I think it's another good time to your point of government stimulus because there was such a heavy government stimulus hit that was giving people more money to spend, during that period of time as well. That created an abnormality as far as some of that spike in inflation and people's desires and willingness to spend more on their homes and spend more because there was also a change in living behavior for a lot of people that right now there's fear, there's not the stimulus, and there's not a change in living behavior that says I want to invest more into my home, apartment, or what have you. So that's definitely something that we look at that leads our view into a bit of a softening economy as well. So thank you for sharing that.
Absolutely. And I mean, we tend to agree. I mean, if you look at the chart on the left here shows that what happens when you have, well, VAT hikes, consumption tax. And, if you look at Japan's example, I mean, every time you have a high tax, inflation drops. So again, speaking to this fact that, again, you tax consumption. And as you said, the US economy is 70% more or less consumption. And chart on the right shows the same thing. The recessions, especially if you get to one, and we don't predict one, but even a slowdown, they don't tend to be inflationary. Again, they tend to lead to demand destruction. They tend to lead to businesses investing less, and even just the trade uncertainty itself, the fact that businesses don't know how to invest until this is clear, that consumers may held up spending, as you said. That again, that's not an inflationary thing. I mean, even if prices are bid because of supply chain disruptions.
And
Uh,
what's a possible scenario then, Dan, is we see some shorter term inflation in certain areas, but likely that coming back down as those disinflationary pressures come in, that when you overlay rates, keeps the rates a bit higher for a while, but then allows rates to presumably come down because of
Right.
disinflation, softening
Right.
economy, which is less of a longer term stagflation, maybe a more shorter term
Sure. Yeah.
stagflation dynamic, but keeping rates up. And I think that's some really good data and information for investors to think about how they're thinking about their portfolio, what they're invested in, where there can be threats and opportunities with a at least higher for slightly longer environment with rates than a softening economy. How would somebody want to be positioning their portfolio to
Right.
capitalize on those opportunities, which is where I think there's a lot of debate around the opportunities in private credit and things like that can take advantage of the higher rates and also take a more potentially defensive approach. So thanks for sharing that, Dan, and just
Yeah.
tying the economics together with it a little bit.
Right. No, and I think that's right. I think at some point the Fed will have to cut if the economy softens. And again, if inflation doesn't spike, I mean, they're not going to, especially with unemployment, which are these two slides, if unemployment starts to pick up, which it may, because again, the tariffs, as I said, as any tax, I mean, they don't tend to add jobs, they tend to subtract. Chart on the right shows the unemployment rate and an indicator of labor market conditions. And again, it could pick up, but that will give the Fed, especially if inflation doesn't massively spike, an impetus to cut. Chart on the right shows the same thing. Shows as unemployment spikes, Fed funds target rate tends to drop.